Chapter 3 here, working with financial statements. In this video, we'll review two key concepts from this chapter, which I think are very important for you guys to retain from all the slides. The first one is the common size financial statement. The second one is ratio analysis. Common size financial statement. Now, this is a form of vertical analysis. I'll write it down. It's a form of vertical analysis. Analysis. Now, financial analysts or anybody in the finance field will use this tool, and they'll tell you that it's a very valuable tool for tracking and analyzing the change in performance of a business over multiple period. It is also used to compare companies within the same industry, right? It converts money into percentage, and I'll explain more in depth. So the first thing I said, it's a valuable tool for tracking and analyzing the change, right? The change, this triangle means change. The change in performance of a company or a business over multiple periods. Okay? Over multiple periods. It's also used to compare the performance, right? Compare performance of companies, right? Multiple companies within the same industry. Whoops. It's always happening to me. Within the same industry. Okay, so common size financial statement or common size analysis is a form of vertical analysis. It's a very valuable tool. It's an important tool for tracking and analyzing the change in performance of a company over multiple period, or to compare and analyze the performance of companies within the same industry. Okay, so we utilize two main financial statements to do a common size analysis. We utilize the balance sheet and the income statement. Now, let me erase that. Okay, so on your balance sheet, common size analysis, you will express all accounts as a percentage of total asset, right? All accounts as a percentage of total asset. Okay, so your cash will be expressed as a percentage of total asset. So it is cash over total asset that will give you the percentage of cash, cash percentage of total asset. And every single line item on your balance sheet will be expressed as a percentage of total asset. Okay, now your income statement, every account will be a percentage of sales, of total sales, also known as total revenues. Okay, so all your line items on your income statement will be a percentage of your total sale or a percentage of your total revenue. I'm gonna rewrite this because I don't want you guys to confuse and do sales over revenue. So on your income statement, to compute your common size, it'll be a percentage of your total sale or a percentage of your total revenues. Okay, it's as simple as that. I'll give you an example as to why common size financial analysis is very important. Common size financial statement is very important, and you will understand why it is done in analyzing companies. So we'll look at two companies. We'll look at Target and we'll look at Walmart, and you guys will see that if you're only looking at the dollar amount, you might not be able to analyze the performance of these two companies, because they're two companies in the same industry. And when it comes to revenue, Walmart is more than 5 times the size of Target. Okay, so we said that common size financial statement converts dollars into percentages, right? So if you're looking at your balance sheets, it's the percentage of total asset. If you're looking at the income statement, it's percentage of your sales or percentage of your revenues. So in 2013, historical data. Target had revenues in the amount of $71 billion. Okay. And Walmart had revenues of $466 billion. So right there, if you're trying to compare Walmart and Target on a dollar basis, you will automatically say that Walmart is performing better. While it's not true, because they're a different size. In order to have a good and in order to have an educated a decision or educated a statement about the performance of these two companies, you need to convert the dollars into percentages. So if you're looking at your balance sheet and you're looking at cash, it will be cash over total asset, right? That's for your balance sheet. Now, if you're looking, that's for your balance sheet. Now, if you're looking at items on your income statement, for let's say, if you want to look at your cost of goods sold and see exactly how you want to compare Walmart to Target, you will do cost of goods sold over your total revenues. Okay, and that will be your common size financial analysis for both companies. All right. Now let's talk a little bit about ratio analysis and what it means and when to use it. All right, so ratio analysis is a tool that is used to compare, to do a comparison between periods or between companies. It is used also internally or externally, because we know that it's not really, it's not good enough to say that a company is in good or bad health. When you're comparing the company between periods, right? Year over year, month over month. Also, it's not enough to say that the company is performing better than the next company. You need to have numbers to be able to compare the health of these companies. You need to have numbers to be able to look at the financial performance of these companies, right? So we said that ratio analysis is used, and it's a better tool for comparing two companies, and it's also a good tool to compare the performance of a company period over period, right? Whether it's year over year, month over month, XYZ. Also, we said that you can use it internally, and I'll tell you when, and you can use it externally as well, and I'll explain to you. So internally, it is this tool is used to evaluate the performance of the company internally, right? Performance. So like I said, it could be year over year or month over month. Also, you use it internally to plan the future. Of the company. Maybe you have a ratio that was behaving a certain way for the past 5 years, and you want to monitor that ratio to see exactly how can you be more efficient in managing your company based on the result you get from computing that ratio. It is also used by people on the outside of your company, like creditors will use it to find out what's the health of your company. Suppliers will use it to find out if they can sell you their goods on credit, right? Customers will use it to find out if you're a good company, if they can get what they're getting from you for a long period of time. Stockholders will use it to find out if they should invest their money in your company. So that's why I said it's a tool that is utilized both by people within the company or people outside the company. Also, the next point I want to make about ratio is as such. The next point I want to make about ratio is this. Looking at a ratio by itself doesn't mean anything. Okay, if you take a simple ratio as the current ratio, for instance, it doesn't mean anything to say that the current ratio is 1.25, right? What does that mean? The ratio should be a benchmark. You can't utilize it by itself and have an idea on how the company is performing. You either need to look at the past periods, the past years' ratios, maybe 3 to 5 years prior, to know exactly what that 1.25 means, or you need to look at an industry average to be able to compare that ratio with, to know exactly how you're performing. So we use the key word here. The key word is benchmark. Okay, the keyword is benchmark. It's a very important keyword you must understand when you're doing ratio analysis. So for the benchmark, you do not want to look at the ratio by itself. Do not look at ratio by itself, right? Whoops, by itself. All right, so I said you need an industry average, or you need to know the performance in prior years. So prior years performance. Okay. Also, I said you need to look at the trend analysis. So the trend analysis is simply the same as the prior year performance, right? You need to look at how the company performed through time. So what are the changes? Remember, this triangle means changes. What are the changes through the lifetime of the company, to the lifetime of the company? And that's the only reason, and that's the only way you can say that you're doing better, or you're not doing performing as you did during the past years. And the third point I'm going to make is a peer group analysis. Peer group analysis is simply comparing companies within the same industry. And this is exactly the same as this point. Okay, so in order to do a great ratio analysis on a company, you need to understand benchmarking. You need to look at the ratios not only by itself, not only the ratio in a single period. You need to either do a trend analysis to find out the change through the lifetime of the company, or you need to look at the companies within the same industry and look at the ratio of the industry and find out exactly how your ratio for the company that you're looking at right this moment, how it compares to other companies within the same industry. Now, financial ratios, I will mention three categories right now, which are very important for you guys to know. Before I move forward with the categories, I'll say this. As I mentioned during the beginning of the semester, and also on my syllabus and on the first video that I did, I do not want anybody to memorize the formula for the ratios. On the slide deck that's provided for chapter 3, all the formulas are there, so feel free to write down these formulas on a sheet. When the exam comes out, you can pull out the sheet to compute the ratios. The goal here for me and my classes and my style of teaching is not for you guys to memorize ratios and spit them out like computers, but I want you guys to start understanding where these numbers are coming from. It's more important to me for you to understand exactly which financial statements the numbers are coming from, as opposed to memorizing the ratios. So do not kill yourself in memorizing formulas, but pay attention to where exactly you have to go to find the numbers to compute the ratio. Okay. All right. So let's go into the main categories of ratios that I think are very important that you will see on a regular basis if you decide to go into finance as a major. Give me 1 second to erase all of that. Okay, so I said there are three main categories that we'll review on this video here. The first one is your liquidity ratio. Okay, this ratio is simply, when you compute this ratio, it says how easily can you convert money to pay your short-term engagements. So it's how easily can a company convert cash to pay down short-term debt, to pay short, whoops, sorry. All right, what's going on here? Okay. Not this one, not this one, not this one. All right. How easily can a company convert cash to pay down short-term engagement, short-term obligations? And those are usually due within 12 months. Okay. These are your liquidity ratios. A very simple liquidity ratios, and the primary one is your current ratio. All right. Your current ratio is simply your current asset over current liability. Okay, current asset over current liability. So this ratio will tell you how easy can the company collect cash within 12 months to pay debt that are due within 12 months. Okay, so how easy can the company collect cash within 12 months to pay down debt within 12 months? And usually a higher current ratio equals a less risky company, and that is the best position to be in, better position. So a high current ratio means that your company is less risky, and that's the best position to be in. All right. The next category that I will mention is called your profitability ratio. Give me a second to erase all of that. I wish there was a button to erase all. Maybe there is, and I don't know. Just started using a Surface, so I'll be better at it next semester. All right. Next category is your profitability ratio. Profitability ratio. Okay. This tells you how good a company is at making money, right? Profitability, profit, right? So it tells you how good, simple terms, right? How good a company is at making money. As simple as that. Okay, so it tells you how good a company is at making money. Profitability, what words can you derive from profitability? Profit. And when you look at profit, profit is all about making money. One of the main ratio in this category is your profit margin ratio, which is simply profit over sales. And when I say profit, that's your net income. Okay. I'll put it in parentheses so you don't go and divide stuff. So profit is mostly your net income. And where can you find your net income? In your sales, on your income statement. Okay. Profitability ratio, how good a company is at making money. Profit margin is one of the ratios that we look at in this category. And it's simply profit over sales. The higher, the better. Of course, the higher profitability, your profitability ratio is, it's a better position to be in. Okay, again, don't kill yourself about memorizing the formulas. I just know them because I've been doing this for well over 10 years. However, when you go to a new job or when you're analyzing companies, you have all the tools in front of you. You have Google to look at formulas. The goal here is for you to know quickly where to go and get the numbers from. For instance, when I said profit or net income, I know automatically it's on your income statement. And when I said sales or revenue, I know automatically it's on your net income statement as well. If I say current ratio or current liability, accounts receivable, accounts payable, I know that's on your balance sheet. That's the level I need you to be on, as opposed to memorizing these formulas. Okay. The last category we'll look at is your leverage ratio. Now, your leverage ratio is one of the ratios that will be used by people outside your company. It'll be used by creditors to find out exactly how how levered your company is, and I'll explain in a minute what that means. This is your leverage ratio. Okay. Leverage ratio is simply, it tells you how much debt the company is using to stay alive. As simple as that. How much debt is company using to stay alive? Okay. Simple terms here. Simple terms. Okay. So this ratio is utilized by your debt holders, by the banks, also by investors to figure out exactly how is management utilizing a debt and how much of that debt is utilized to keep the company afloat. Okay, and if you are if the company has a low leverage ratio, that is a better position to be in. As simple as that. Okay, So, as I mentioned, these are the categories for me that are more practical in today's ratio analysis. Of course, you have to understand there are tens and multiple ratios. The PowerPoint slide for chapter 3 goes over a majority of these ratios. Please take your time to look at the ratios. Please take time to find out exactly what financial statement there are in, or they go to pick numbers. For instance, what I'm trying to say is that if I say current ratio and I say current asset and current liability, you should easily and quickly know exactly what financial statement to go to. You know that all your current asset and all your current liabilities are part of your balance sheet. If I say accounts payable, you know that's in your balance sheet. If I say equity, you know it's in your balance sheet. If I start talking about profitability and I start talking about sales and revenues and net income, you know that those line items are found on your income statement. To me, that is more important than memorizing the formulas. All right, that's the end of the video. If you guys have any additional questions, please feel free to email me through Canvas. That way myself or Ali can make sure we answer your question on time in a timely manner. Thank you very much. Have a good one.